Next, we'll look at scenario analysis. So this is a little bit more sophisticated where we say, let's take a scenario from a business standpoint, what may occur, and then say, if that scenario occurs, what would happen to the assumptions? And then let's run through those assumptions as a batch, because there will be multiple changes in a scenario, and just see what happens to our desired outcome, again, in this case, NPV. And in this example, we have a best, a base case, and a worst case. We assign certain probabilities of those occurrences happening. And if they were to occur, we would have certain changes in the assumptions that lead to these NPVs. So we have a base case, which we've had along. Best case scenario with a quarter probability has an impact of a positive 279. Worst case, also 25% probability, we go negative 59. Now we can use an expected value calculation, which is simply probability times NPV and adding them up. Or if you want to be an Excel expert, use sum product, right? Because we're summing the products of these two columns. Here, the expected net present value is 101.6. Notice that this number is higher than 88. And the reason for that is the high side probability is equals a low side probability, but the dollar magnitude of that jump, if it were a best case, is quite dramatic. So it pulls up the expected value above the base case NPV. The standard deviation is 116, and that's kind of scary that the amount of variation could be so high. And so what we look at is the coefficient of variability, which is the standard deviation of NPV divided by the expected NPV. It's 1.15. So it's a fairly high coefficient of variability. So are there any problems with scenario analysis? Well, of course, it considers only, in this case, 3 outcomes. There could be many more. Also, it looks at there's correlation, that all bad things happen at the same time or all good things happen together. That may or may not be true. So there might be some interaction that we're missing. And finally, it's still on standalone. It doesn't look at other things that may occur outside of these particular variables. The third technique is simulation. Simulation is statistically based, it's computerized, and what it's doing, it's allowing you to have many variables, and for each of them, you specify what is the expected result, and then the amount of variation for each one of those assumptions. Then it just throws through using upwards of thousands or 10,000s of iterations. So you get these distributions all interacting at the same time through random selections of each of the variables that have the specified amount of standard deviations. So you're letting the variables have a expected amount, and then you're measuring and allowing it to move up and down based on the statistical probability of a standard deviation. Sometimes you hear the term Monte Carlo simulation, and we use this to throw against it thousands of iterations to get kind of what is the central tendency of the reported results of the NPV, of the IR. Generally shown graphically, which is quite a powerful set of graphics. All right, so let's look at examples of this. Let's say we had 2 critical assumptions. So one is unit sales and the other is unit price, where we have a mean of 1250 sold and a standard deviation of 200. Again, we take one critical assumption, identify it, set the mean, and set the standard deviation. Then we take a second one, in this case unit price, and we have a mean of 200 and a standard deviation of $30. Then what we do is we run 10,000 or so iterations against the distributions that we derived here and say for each of these combinations that were for these 10,000 runs, what is the distribution of the NPV? And the results are seen here, that the mean in the random simulation was 1252. Notice the mean of the population prior was 1250, so we're right on track. The price was right at the same number, 200. The NPV that came through these 2,000 runs is 88,808, which is, again, very close to what we had. Standard deviation of 199, really close to what we had given the model at 200. The standard deviation of price exactly happened at 30, so it just means the iterations did reflect the probabilities and standard deviations that we had preset, and we have a min and a max. The value of this distribution is we can also say, given the 2,000 observations, what percent of those are below 0? and we could say, or above zero rather, that it's 87% are above zero. So that gives us some comfort that there's not a lot of downside risk. And furthermore, we could say, what's the coefficient of variation now that we're having the interaction of these variables? Is 0.93. So it's actually not as bad as we had seen in that previous example. If we interpret the result, kind of the so what of this, it says, what are the inputs? Inputs here were two variables, units sold and the price. And we set, hopefully based on data, what is the mean and what is the standard deviation. And furthermore, we notice that we have a nice positive NPV, a low probability of negative, and the coefficient of variation is within project risk. It's still high, it's over 0.4. Let's say that's the average of the firm, but it is superior to what we'd seen previously. With a 3% risk adjustment, should our project be accepted? If we have the rate of return go from 10% to 13%, then the NPV drops, and it drops to 65,000. Now, it drops, but it's still positive. Therefore, even with a 3% increase in risk, because we didn't like the CV, even if we did that adjustment, we're still in good shape. So it's a riskier project than our standard, but even with a compensation for that risk, it still looks pretty good. We'll have some final comments on simulation. There are advantages. It reflects probabilities, so it has more precision, and it shows a range of NPVs, and it gives us this intuitive graph that gives us a sense for what's the chance of a positive outcome, what's the chance of a negative outcome. Disadvantages, who knows what the distribution are. So if we're trying to guess into the future of what might happen to market rates and market prices, it could be difficult to do. The next comment is just something I believe in, and we see this all the time in many instances, is if the inputs are bad, the outputs are bad. In other words, garbage in, garbage out. So hopefully we make good assumptions related to the variables and their distributions.